Good morning, I'm Tong Zeng. This 5-minute will briefly summarizes my business report on PayPal Holdings. PayPal operates a global two-sided payment platform that connects consumers and merchants in roughly 200 markets, with 434 million active accounts at year-end 2024. Market position is underpinned by scale. Its two-sided network and unified merchant platform support global reach and partner integrations. For the competitive strategy, PayPal adopts front-end differentiation and back-end cost efficiency. Now let's turn to the analysis. This chart checks break-even points in dollars from 2022 to 2024. It shows a decline trend first, indicating better unit margins and lower fixed costs. In 2024, it climbed to the highest, now about 2% above 2022, which tightens safety margin. It is clearly shown that the trend flipped from favorable to adverse, so today PayPal needs more revenue to cover costs. PayPal's leverage pattern evolves from negative operating leverage in 2022 to a strong rebound in 2023. Then there was a normalized milder leverage effect in 2024. It can be concluded that leverage is now sustainable, but EPS is less sensitive to the top line than in 2023. PayPal should maintain broadly steady leverage and strong interest coverage, driving EPS through operational efficiency, tight fixed cost control, and conversion gains rather than additional debt. Operationally, PayPal lower unit costs through two levels. For the structural one, PayPal make workforce and real estate streamlining and one PayPal platform consolidation to reduce fixed costs. For the essential one, PayPal tighter underwriting, automated chargeback, and smart payment routing to reduce variable per transactions. This is the analysis of company's capital structure policies. For debt ratio, the trend is basically stable and slightly higher, showing that liabilities mainly support assets and the leverage is in high but controllable range. While its debt to equity ratio points to a slightly higher balance sheet leverage over time. For TIE, though there is a slightly fallback, it is still at a stable level around 13 and 14, indicating that it has a strong ability to cover interest with operating profits, and the financial risk is not high. This is PayPal's peer Block. Block shows much lower structural leverage than PayPal. The line chart shows that it is well below PayPal's debt to equity ratio, indicating Block relies far less on liabilities relative to equity. The EBIT turned negative to positive in 2024, which is a clear significant improve. In conclusion, compared with Block, PayPal's leverage is higher, but revenue quality and interest coverage are better. Block's leverage is lower, but there will be operating losses in 2022 to 2023, and it will not return to favorable coverage until 2024. From my opinion, PayPal is at the upper end of the prudent range. It should hold leverage broadly steady rather than add to it, and prioritizes protecting coverage given rising financing cost sensitivity, such as control financing costs and use operating cash flow to support capital expenditure. PayPal has one class of common stock. Preference stock is authorized but non-issued. There are no routine public equity raises. Share count mainly changes via employee equity plans. The company has never paid a regular cash dividend and doesn't expect to in foreseeable future. PayPal's 2024 WACC is 6.63%. It sits between the after-tax cost of debt and the cost of equity and is close to the equity, indicating a relatively low hurdle rate and signals that today's funding mix keeps the company's overall cost of capital contained. For PayPal, ESG performance is also embedded. On environment, it produces TCFD-aligned climate disclosures, targets net zero by 2040 with science-based interim goals, and so on. On social, the company launches products and plans around inclusiveness and inclusion. On governance, it integrates privacy and cybersecurity into enterprise risk management and broad oversight. In conclusion, PayPal's capital structure is on the high side but prudently managed and sustainable given strong interest coverage and stable profitability. There are some recommendations. PayPal can hold leverage broadly steady, protect coverage and flexibility, make better capital allocation, and so on. However, there are also some limitations for this report. Some ratios use total liabilities. WACC just depends on assumed beta. The peer sample is just one company, and so on. That's all. Thank you.